All right, let's get right into it. In 2026, one of these two mortgage choices could save over $9,000 on a $700,000 mortgage. But there are risks, and most people don't see those risks coming, and they can wipe out those savings in a flash. The choice between variable and fixed mortgage rates in Canada has never been more critical. And in this video, we're going to break down the exact numbers and pull back the curtain on the risks that could erase all of your gains or savings and give you a definitive strategy to make sure you make the right call for your money and your future. Let's be honest, for the hundreds of thousands of Canadians buying a home or renewing or refinancing a mortgage in 2026, the choice between fixed or variable can sometimes feel completely paralyzing. On one hand, you see headlines about huge potential savings, and on the other, you hear whispers of economic uncertainty and you see the past rate cycle we just went through. It's a classic battle between your desire of saving money or feeling secure. And here's my promise to you. By the end of this video, that uncertainty, it's going to be gone. You'll not only understand the real numbers behind the headlines, but you'll also have a clear, simple plan to walk through. You'll know exactly which questions to ask yourself to pressure test your own finances and how to confidently choose the mortgage that actually fits your life. First up, let's talk about the option getting all the buzz, the variable rate mortgage. Its appeal is simple, but very powerful, a low initial interest rate. A variable rate isn't just a random number. It's tied to your lender's prime rate, which is tied to the Bank of Canada policy rate. Following a series of cuts, the Bank of Canada's policy rate is now down to 2.25% as of late 2025. This has pushed banks' prime rate down, allowing for some very attractive variable rate mortgage options. So, what do the numbers look like for an example? Let's say someone's buying a house for $750,000 and they're putting 10% down. After CMHC insurance is included, the total mortgage is $695,925. As of today, you could get a 5-year variable interest rate at 3.75%, and in contrast, a competitive 5-year fixed rate is sitting slightly higher at around 4.04. Now, let's apply this to our $695,925 mortgage, amortized over 25 years. With a variable rate at 3.75, your monthly payment would be about $3,567.01 in change. With a fixed rate of 4.04%, that same mortgage would have a monthly payment of $3,675.81. That's a difference of over $108 every single month, increasing your cash flow. It might not sound life-changing, but over a 5-year term, that adds up to over $6,500 in payment savings alone. But here's the real kicker, the interest cost. If the variable rate were to hold steady for the entire 5 years, you would pay $121,259.62 in pure interest, compared to $130,875.11 with the fixed rate option. That's a savings of $9,615 that could go towards principal, investments, or just improving your quality of life. Beyond the potential savings, variable rates have another huge advantage: low penalties if you break your mortgage early. Life happens, a new job, a bigger family, or a sudden need to move because of your crazy psychotic neighbors. With a variable rate, the penalty in Canada is almost always that 3-month interest penalty. With fixed rate mortgages, you could be on the hook for one of those interest rate differential or IRD penalties that I talked about in my last video, which can be incredibly expensive, sometimes running into the tens of thousands of dollars, especially if you break it when rates have fallen significantly. Now let's flip the coin and talk about fixed rate mortgages. This option is built with one simple, powerful word: certainty. When you lock in for a 5-year fixed rate of 4.04%, you're making a deal with the bank. Your interest rate on your payment, well, it's set in stone, and for the next 60 months, it's not going to change. No surprises. You won't wake up to headlines about the Bank of Canada hiking rates and finding your mortgage payment has jumped. It's peace of mind, and that's what you're paying a premium for. But what's the risk of not choosing stability? This is where the hidden dangers of a variable rate can pop up. While the Bank of Canada did cut rates, the economic outlook is still pretty murky. Forecasts are mixed. Some economists are saying rates are going to hold steady, others are saying there's potential for slight rises, and some are saying that rates are going to come down. The only guarantee is that nothing is guaranteed. So let's play this out. You took a variable rate at 3.75%. You're saving $108 a month. You're feeling pretty smart, but a year into your term, thanks to stubborn inflation or a surprisingly strong economy, the Bank of Canada is forced to increase rates by 0.5%. Your variable is going to jump from 3.75% to 4.25%. Suddenly, your monthly payment on your mortgage increases by about $200 a month. Your monthly savings is gone, and you're actually now paying more than you would have if you took that fixed rate that you passed up. If rates climb by a full 1% over the next couple of years, which to be honest is a totally plausible scenario, well, then your monthly payment goes up by $400 or more than where you started from. In this scenario, that $9,615 of potential savings doesn't just vanish, it reverses into a net loss. You could end up paying thousands more in interest over a 5-year term than if you'd just taken the boring fixed rate from day one. This is the trade-off. A fixed rate is your insurance policy against a volatile future. It protects your budget and lets you sleep at night, knowing your biggest expense is locked down. It's conservative and security first. So one choice offers tempting savings with risk, the other offers security with higher costs. How do you decide? You don't guess. You don't flip a coin. You use a plan. Here's a 3-step process that can make the right choice for you seem much more clear. Step 1, check your personal risk thermostat. This is the most important step, and it's not about numbers. It's about how you're wired. Ask yourself honestly, are you a sleep well at night person, or are you a chase the savings person? If the thought of your mortgage payment bouncing around, watching the Bank of Canada news with a knot in your stomach causes you real stress, your risk thermostat is low. For you, the peace of mind from a fixed rate isn't just a feature, it's the whole point. The extra cost is what you pay for that calm. But if you're comfortable with market swings, if you see potential rate hikes as a manageable risk in a long-term game, and if leaving potential savings on the table bothers you more than the risk of higher payments, your risk thermostat is high. You're a natural candidate for a variable rate mortgage. Now, you need to be honest. There's no right or wrong answer here. Only what's true to you and what works for you. And that brings us to step 2, stress testing your budget. We're going to get into some numbers here which are inspired to help you work with your numbers. It's not enough to know that you can afford your payment today. You need to know that you can handle it even if rates go up. So take out your monthly budget. If you don't have one and you need a tool to help you build one, let me know. I'll send you one. And you're going to want to look at an estimated variable rate payment. Now, in our example, we used a payment of $3,567 per month. So whatever your payment is, add $200 to it. This simulates an interest rate hike of around 0.5%. Now, that's not exact math, but we'll use it for this example. Does your budget still work? Is it tight, or is there still a comfortable buffer? If it's still comfortable, do it again. Add $400 to that initial payment, simulating a full 1% increase. What does your budget look like now? Are important things like savings, retirement, or kids' activities suddenly on the chopping block? If a $400 a month increase would put your family's finances under serious stress, a fixed rate might be a better and more responsible choice for your mortgage. If you look at that number and can honestly say it would be annoying, but we could handle it without any major sacrifices, then you have a really good financial cushion and you can definitely consider that variable rate mortgage. This simple stress test turns a vague fear into a concrete financial answer and can be hugely helpful in making this decision. And finally, for step 3, you want to look at your 5-year roadmap. Where do you see yourself in the next 5 years? People always forget to ask this. Your mortgage term isn't a life sentence, but it is a 5-year contract. Are you in your forever home? Or is there a real chance you might move for a new job or a bigger house or to be closer to family? This is where those mortgage penalties become a massive deal. As we mentioned, breaking a 5-year fixed mortgage can trigger those painful IRD penalties. Any fixed mortgage, really. Breaking a variable rate mortgage is almost always a simple 3-month interest penalty based on the prime rate of Canada or your contract rate. If you have any real uncertainty about your plans over the next 5 years, the flexibility of a variable rate offers a huge, often overlooked financial protection. On the flip side, if you are absolutely sure you are not moving, the stability of a fixed rate becomes more attractive, since the risk of higher penalties is much lower. Now, before we wrap this all up, here's a bit of a bonus option, a way for those people who are wanting to use the savings of a variable rate and to kind of create the stability of a fixed rate, all while getting a little bit ahead on their mortgage. This is for people who pass the budget stress test and want to really pay their mortgage off just that little bit faster and create a buffer. Here's how it works. Take the variable rate mortgage at 3.75%, but you set your monthly payment as if you had that fixed rate mortgage at 4.04. In our example, you take the variable rate with the base payment of $3,567, but you voluntarily pay $3,675 every month, the same as you would with the fixed rate option. That extra $108 each month isn't just going to the bank, it's going directly onto the mortgage principal. This does 2 incredible things for you. First, you accelerate your mortgage payoff. Over the 5-year term, that extra principal payment helps you pay down your loan faster. Second, it builds a safety buffer. If the Bank of Canada hikes rates by 0.25%, your actual required payment will rise, but since you're already overpaying, your cash flow doesn't change. The increase just eats up that extra $108 prepayment. It's a powerful way to hack your mortgage for faster payoff and peace of mind. So, what's this guaranteed strategy I promised? It's not about trying to outsmart or time the market. No one can do that. The guarantee is that by honestly assessing your risk tolerance, stress testing your real budget, and matching your choice to your life plan, you will make the decision that is undeniably right for your specific situation. The best choice isn't the economic forecast. It's your budget, it's your personality, and it's your plans. People on TikTok be damned. Your mortgage is for you, and what they get is for them. So make sure your mortgage is designed and specifically designed for you and your situation. By walking through this 3-step framework, checking your risk thermostat, stress testing your budget, and looking at a 5-year roadmap, you can cut through the noise and make a decision that feels good to you. Now, if you want to run these numbers for your own situation, I've dropped a link in the description for some of my free mortgage comparison calculators, and there's also a link where you can book a call with my team where we can look at your unique situation. We've helped hundreds of thousands of Canadians. We've done over $2 billion in mortgages, and I'd be more than happy to book a free consultation to help you as well. And I do want to hear from you. Based on this, what are you leaning towards, fixed or variable? Let me know in the comments below. Your story could help someone else who's on the fence. And finally, if this breakdown gave you some clarity, a thumbs up and a subscription would be massively appreciated. My name is Miles Noack of the Noack Mortgage Team, powered by Indy Mortgage. Thanks for tuning in. We'll catch you on the next one.